Greetings my YouTube family, thank you so much for visiting this channel, and today I'm going to talk about dividend oriented investing. Some people might be thinking, like in my case, of ways to get passive income. So one way is to actually invest in stocks, individual stocks or index funds or ETF, that is exchange traded funds that pay out dividends. In other words, that is part of the money that the board for the companies decide to give back to the shareholders in form of dividends. But before I get started, I just want to disclaimer that this content is just for educational purposes, as such it should not be taken as investment advice. So particularly in the United States and Canada, there are well-known companies that actually pay out dividends, and they have a categories that they fall in. For example, dividend achievers are those stocks that have been increasing their dividend at least for 10 years in a row. So you just look at their yield every year increasing, so that means more dividend income will be coming in if you own those shares. And then for the dividend contenders, these are those publicly traded companies, and their dividends have been increasing for the past 10 and 24 consecutive years. And the dividend champions companies have been increasing their dividend for at least 25 years in a row, regardless of whether they are in part of the S&P 500, that is the top 503 companies as it is constituted in the United States. So they can be outside of those 503 as long as they are publicly listed in the United States. So these are dividend champions, and the popular ones are called dividend aristocrats, and these have been consistently increasing their dividend yield for the past 25 years in a row, and they are specifically in that category of the S&P 500. And then the dividend king, as they are called, they actually have been increasing their dividends for the past 50 years. So you find out that there are a lot of other actually good companies that are listed in the United States or even in Canada that have a high dividend yield and still have good value in terms of their share appreciation. So in other words, if you invest in those companies, you can have your capital appreciation. In other words, if you buy the shares, they can appreciate and still collect some income from those dividends. And generally dividends are paid for most companies. Some they pay monthly. Actually, I've seen quite a number of exchange traded funds, mostly those that write calls, for example the ones from the Hamilton Finance, and what they do is they pay every month and they are writing calls, and then they collect some extra income which they distribute to their shareholders. But a lot they pay every 3 months, in other words every quarter. So you get a paycheck. It can be in form of cash, and it can be a good source of income. And the advantage of having dividend income, as I've seen in Canada, of course you should always consult your tax advisors, that they are taxed at a different rate, which I think might be actually preferable or lower than the employment income. In Canada, I saw on the Canada Revenue Agent, it's like 15%, 9%, depending on what stocks or security that you hold, as long as that company or that share is listed in the United States. It means they are taxable. So there are tax implications. In other words, if you buy shares in the United States, even if they pay dividends, they can be taxed. So it's very important to consult tax advisors to make sure that you optimize on taxes. And like I said, some companies, they are very stable. There are companies like Chevron in the United States, they have been increasing their dividends. Even Procter & Gamble, there are quite a number of them. So it can be an advantage to have companies that really give you part of their profits. Sometimes people need cash as they go. So I thought I would just share that could be another strategy that some investors, particularly individual investors, might consider. But the challenge is that you need quite a lot of money to have a significant dividend. For example, the dividend yield for the S&P 500 for this year actually was 1.14%. So what that means is, like, for every share towards the for the year, if you invested at the beginning of the year, you would have received $6.65 a share, but one share is over $400. So it means there is that barrier in terms of, if you really want to rely on that. But what they like is that S&P 500, for example, it goes up on average every year over 10%, at least for the past 30 years. And of course, things can change, as history cannot necessarily or solely be used as a basis to predict the future. But at least you can have some income and also have the capital appreciation. So for some people, they prefer stocks that appreciate rather than just dividends, paying out dividends. But every person's financial circumstance might be different, so I like to have a mix of those and just collect some dividend income in case I need to reinvest them, or perhaps even use them as a source of income. So that's it. I thought I would just share that for now, and please don't forget to subscribe down below so that you don't miss content like this in the future. Thank you.